Welcome to the Retiring Canada podcast, where our mission is to educate and empower you to make the most informed, rational, and productive financial decisions. Hosted by certified financial planner, author, and chartered investment manager Michael Isbister, you'll go behind the scenes to uncover the tips and strategies to help you invest smarter, optimize your retirement income, and reduce the amount of tax you pay. Michael is an investment advisor with Fundamental Wealth, a trade name of Harbourfront Wealth Management, an IROC dealer. And now, here's your host, Michael Isbister.
Hello everyone, and welcome again to the Retiring Canada podcast. In today's episode, we're going to discuss entering retirement with an overconcentration of stocks. Specifically, I'm going to chat about what stock overconcentration looks like, the pitfalls this can lead to in retirement, the impact of stock options and company-associated risks, ways to mitigate the tax implications of making a switch, and lastly, as always, a few action items for you to consider. Now, over the course of my career, I've come across many portfolios that I would call interesting. Anywhere from a penny stock that was a hot tip from a father's, brother's, nephew's, cousin's former roommate, to vested company stock positions acquired over a career at a private or publicly traded company, now worth hundreds of thousands, if not millions of dollars. Either way you slice it, an overconcentration of investments has the ability to completely decimate your retirement. We've all heard the phrase, don't put all your eggs in one basket. But when it comes to our investments and retirement portfolios, this parable tends to get lost on some. Which in some sense I can understand, especially for those of you with company stock options. Whether these options were a matching program, earned through performance or other means, there may be a point where not only does your annual income rely on the success or failure of this company, but also your retirement. Now, an extreme example of this over-reliance would be the story of Nortel Networks, the former Canadian telecommunications behemoth that filed for bankruptcy in 2009. Now, during its run, on paper, employees were seeing tremendous returns, and many chose to continually exercise options or buy more stock outright. Stock prices ballooned, and again, on paper, many employees were now millionaires. Fast forward to after the dot-com bubble, the price completely crashes, leaving many employees that were once paper millionaires now being forced back to the 9-to-5 and saving for retirement. Now, obviously, with hindsight, we can look back at this and say, well, I wouldn't have done that. But we're all human and could have very easily taken the same path as many of Nortel's employees. Now, many of you listening may not have this kind of employee stock option plan, but you're not out of the woods either. If you open your investment statement and see 20 or 40 individual stock positions, I would argue you are also overconcentrated, albeit not in one single company, but overconcentrated nonetheless. So what's the answer? You've probably already guessed it. Diversification. Diversification has been called the only free lunch in investing. This claim is rooted in Harry Markowitz's work on modern portfolio theory, which showed that through diversification, combinations of assets could reduce volatility without reducing expected return, or increase expected return without increasing volatility relative to individual assets. In practice, this kind of diversification is easily attainable through a low-fee solution that diversifies globally to give an investor the best opportunity for a strong, risk-adjusted rate of return. So, if you find yourself staring at your investment statement that only holds individual stock positions, I would suggest that you're likely overconcentrated and that you're hoping to guess your way into retirement as a stock picker versus embracing diversification, removing the crystal ball, and becoming a long-term investor with a plan. Going back to my discussion about individuals who find themselves with a significant overconcentration in one stock, Maybe this one stock was a part of the share purchase plan, stock options as a part of compensation, a company that was bought into when it was private and is now public, or maybe you were just an early investor in a company that has grown leaps and bounds. Either way you slice it, there is an emotional attachment to this stock, as it is likely a cornerstone of your wealth accumulation journey for your portfolio and for your family. However, sophisticated investors know deep down that this stock represents more volatility than what is prudent, as the success of this one stock could threaten their livelihood, and the simple fact is that even large companies can fail, especially during uncertainty. I was out for lunch with another investment professional a few months back who came across a scenario where two founders of a cannabis company had built a successful brand and rode the hype to the point where their shares were now valued well into the 8 figures. Now, one founder realized the risk, took the chips off the table, and chose to diversify, while the other founder rode the crash all the way to the bottom. Now, this is another extreme case, but it highlights the importance of removing emotion, primarily fear and greed, to make way for prudent investment decisions to protect your wealth. Now, to address concentration risk, the benefits of a diversified portfolio have been well documented by academic research. But here lies the rub. How do you diversify away from this single stock without taking a substantial tax hit? Well, there are a few options. First is to borrow against the stock, which will then require ongoing interest payments, restrictions on the amount that can be borrowed, and the potential for a margin call if the value of the stock drops below a certain threshold settled by the lender. Second option would be to consider a hedging strategy that protects the value of your stock while allowing for potential upside. However, this is likely only a short-term solution that will require expert investment expertise at a cost and may not even be possible depending on where your stock is held. Another option is just to simply sell the stock, realize the gain, and buy a diversified portfolio with the after-tax money, which, with the rise of the capital gains inclusion rate to 2/3 after $250,000, makes this option a tough pill to swallow. Lastly, you could consider an in-kind exchange by making a subsection 39(4) election and a subsection 85(1) election under the Income Tax Act. Utilizing this process would allow for tax deferral of an individual stock in exchange for a diversified portfolio. Generally speaking, if your capital gain is north of $100,000 or more, this strategy would be something you could consider. Now, I understand this last strategy has quite a bit of industry speak laden throughout. So, in its simplest terms, this advanced tax planning strategy will help you not only control the timing of tax, but also achieve a globally diversified portfolio, a true win-win. So if you have a single stock position in a non-registered account with a substantial capital gain, and you're looking to diversify this holding to reduce your risk, speak with your tax advisor about the options I've laid out. And if they make sense and you're keen to learn more, get in touch with our team and we can help. Okay, so that will do it for today. Here are your action items for today's episode. If you're an employee or C-suite executive with a heavy concentration of stock in the company you represent, I urge you to take a step back and objectively look at your investments. Remove the emotional attachment you have to that stock and ask yourself, if I looked at my parents' investment portfolio and witnessed this type of overconcentration, what would you suggest? Lastly, if you have a stock portfolio with 20, 30, or even 50 holdings, be sure you aren't missing out on the greater market returns. Diversification is your friend, and I encourage you to get acquainted. Okay, that'll do it for today's episode. Be sure to add us to all your socials, LinkedIn and Facebook. Leave us a 5-star review in your favorite podcast app. Be sure to sign up for our weekly Retiring Canada newsletter. And hey, when it comes to your retirement, don't take chances. Make a plan so you can retire with confidence.
All comments are of a general nature and should not be relied upon as individual advice. The views and opinions expressed in this commentary may not necessarily reflect those of Harbourfront Wealth Management. While every attempt is made to ensure accuracy, facts and figures are not guaranteed. The content is not intended to be a substitute for professional investing or tax advice. Please seek advice from your accountant regarding anything raised in the content of the podcast regarding your individual tax situation. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.